What is ATH? What should traders do when it appears? ATH is a familiar and common term in the cryptocurrency market. The beauty of an asset reaching ATH is that everyone who bought the asset made a profit. All-time high is often abbreviated as ATH. This term refers to the peak price of a cryptocurrency or any other asset from the past to the present time. If investors buy at the bottom of any cryptocurrency and sell at the top, there will be a huge source of profit. Conversely, if you buy at the top and sell at the bottom, you will suffer a large loss. For example, Ethereum bottomed in 2018 at $150 and by 2021 has reached an ATH of over $4,000. If you bought at $4,000, then at this point you are suffering a huge loss as the ETH price on March 15, 2022 hovers around $2,548. Meaning of ATH. The appearance of ATH means that the price of a certain cryptocurrency or asset has reached a new price that has never been seen in the price history before. At the time of the ATH there was no oversupply or the effect of trying to sell by the bears. The bulls will try to create enough pressure and strong enough against the bears to push the price up. It is this situation that will lead to imbalances and bring huge profits to many smart investors. However, ATH often tends to generate emotional behavior and investment decisions rather than applying conventional technical analysis methods. What to do when ATH appears? Investors need to use indicators in technical analysis such as Fibonacci, moving average, to determine the point of taking profit. If ATH appears, then this is the time when investors should enter a sell order, specifically as follows. Measure price dynamics. With this method of measuring price dynamics, you can imagine the market like a spring. If the spring wants to turn strongly, the process of gaining momentum must also have an equivalent motivation. Therefore, in order for the market to rise to the ATH level, it will also have to undergo a stabilization or decline in order to gain momentum and have a breakthrough in the future. Therefore, when using this method, investors can rely on actual observations in the market to determine when to place orders. In particular, the method of measuring price dynamics can be applied on different time periods, so it is preferred by many investors. Apply Fibonacci. Fibonacci is an indicator in technical analysis consisting of a series of digits starting from 0 and 1 with the following numbers being the sum of the previous two numbers. Investors can use Fibonacci to measure support and resistance levels. From the series of numbers, one can analyze the most commonly used ratios: 23.6%, 38.2%, 50%, 61.8%, 78.6% and 100%. These points are usually horizontal to help identify support and resistance points. In the chart above, it is easy to see the values corresponding to each Fibonacci ratio as follows: 42,505, 49,233, 53,395, 56,759, 60,122, 64,912 and 71.012. In which Fibonacci 23.6%, 61.8% corresponding to prices 49,233 and 60,122 act as support and resistance points. In this case, if the ATH after 64,912 breaks through the resistance at 78.6%, it is likely that the price will continue to grow. Conversely, if ATH just stops at resistance and bounces back, the price will reverse from bullish to bearish. Refer to the moving average MA. Moving average, also known as moving average, is often used by investors to predict future movements of the cryptocurrency market. In case the price of any asset is below the MA line, it is likely that the price is trending down. Conversely, in case the price of any cryptocurrency is above the MA, the uptrend will continue. However, for this method, investors need to determine the exact time frame so that the price trend is best represented. Like and subscribe our channel.